In 1923, Jesse Livermore was the most feared trader on Wall Street. 40 years later, Mark Douglas was teaching nervous beginners the psychology of trading. Between them, Marty Schwartz, Bill Lipschutz, Paul Tudor Jones. 5 men, 5 completely different strategies, 5 different eras. They had nothing in common, except for one thing, and it's not what you've been told. Most trading books will tell you it was discipline, or risk management, or some secret edge. They're wrong. The trait these 5 traders shared isn't taught in any course. It isn't found in any indicator, and most traders will spend their entire careers fighting it, instead of building it. In the next 22 minutes, I'm going to show you exactly what it is, using their own words, and how you can build it before you blow up another account. Here's how this is going to work. I'll introduce each trader. I'll show you what they each said about being wrong, and then I'll reveal the single trait they all shared. Stick around. The answer changes how you'll look at every loss you take from here on out. Let's start with the man who started it all, Jesse Livermore, born in 1877. By the time he was 15, he was working in a Boston brokerage office, posting stock prices on a chalkboard. He didn't go to college, he didn't have a mentor, he just watched the tape and learned to read it better than anyone alive. By his 20s, he was making thousands a day in New York. By his 30s, millions. And in October of 1929, when the market crashed and wiped out fortunes overnight, Jesse Livermore made $100 million in a single week. But here's what most people don't know about Livermore. He didn't just make fortunes, he lost them multiple times. He went bankrupt, he came back, went bankrupt again, came back again. He lived through wins and losses on a scale most traders can't even imagine. And in 1923, at the peak of his career, he wrote down what those losses had taught him. These are his exact words. "Losing money is the least of my troubles. A loss never bothers me after I take it. I forget it overnight, but being wrong, not taking the loss. That is what does the damage to the pocketbook and to the soul." Read that again, because most traders read this quote, nod along, and miss the entire point. Livermore isn't saying losses don't matter. He's saying something much more specific. He's saying the loss itself isn't the wound. Refusing to take the loss, that's the wound. Think about what that means. When a position goes against you, there are 2 separate events happening. There's the financial loss, and there's the emotional refusal to accept it. The amateur experiences both as the same thing. The market goes against them, and they freeze. They move the stop. They average down. They tell themselves it'll come back. Why? Because they can't separate the loss from the feeling of being wrong. And that's the trap. Livermore figured out something most traders never do. The loss is just math. It's a number on a screen. It's information. But being wrong, that's an identity wound. That's the trader's ego saying, I should have known, I made a mistake, I'm not as good as I thought I was. And the longer you sit in that wound, the longer you refuse to take the loss, the worse the actual financial damage gets. Livermore's insight is brutal in its simplicity. Take the loss. Forget it overnight. Move on. Not because losses don't matter, but because the alternative is so much worse. Now, Livermore wrote those words 100 years ago. You'd think we'd have figured this out by now. But here's the strange part. Every legendary trader who came after him said almost exactly the same thing. In their own words, in their own way, with their own scars to back it up. Starting with a man who shorted the 1987 crash and walked away with one of the greatest single trades in history. Paul Tudor Jones. Paul Tudor Jones is the trader who made the leap most traders dream about. In October of 1987, the US stock market lost more than 20% of its value in a single day. Black Monday, the biggest one-day crash in history. While most of Wall Street was being destroyed, Tudor Jones had positioned short going into it. He didn't just survive the crash, he made his fund a return of 62% for the year. He went on to build Tudor Investment Corporation into one of the most successful hedge funds of the modern era. Today, his net worth is north of $8 billion, so when Tudor Jones talks about losses, you might expect him to sound like someone who avoids them, someone who's figured out how to stop losing. He doesn't. Here's what he actually said. "I'm always thinking about losing money as opposed to making money." Read that twice. The most successful trader of his generation, a man who has made billions, spends his time thinking about losing, not winning. That's not a coincidence. Tudor Jones called himself, in his own words, a premier loss taker. Not a premier winner. A premier loss taker. That phrasing is everything. Most traders treat losses as failures, things that happen to them when something goes wrong. Tudor Jones treats taking losses as a skill, something you actively practice and get better at over time. And here's why that mindset matters so much. If you treat losses as failures, you avoid them. You hesitate before pulling the trigger on a trade. You move stops to avoid being wrong. You hold losing positions too long because cutting them feels like admitting defeat. But if you treat taking losses as a skill, as part of your job, then taking a loss becomes a small, ordinary act, like a chef chopping onions. Nothing emotional about it, just the work. Tudor Jones doesn't fear losses because he's expecting them. Every single trade. He plans for them. He sizes positions assuming half of them will go wrong. And that expectation is what frees him to act. The amateur freezes at the moment of decision because they're trying to be right. Tudor Jones doesn't freeze, because being right was never the goal. The goal was always just to play the probabilities and take whatever the market gives him, wins or losses. He's not avoiding losses, he's not afraid of them. He's already accepted them before the trade even begins. Now, Tudor Jones learned this through experience. He blew up early in his career, lost a huge chunk of his clients' money on a single bad trade. He talks openly about how that experience reshaped his entire approach. But the next trader on this list figured it out a different way, through $300 million made in a single year and one phone call that almost killed him. Bill Lipschutz is a name most retail traders have never heard. But on the institutional side, he's a legend. Lipschutz ran the foreign exchange desk at Salomon Brothers in the 1980s, one of the most powerful trading floors in the world. At his peak, he was making $300 million a year for the firm, trading currencies. With size most traders can't comprehend, he learned to trade, by his own account, by losing his entire inheritance. $12,000 his grandmother had left him. He turned it into $250,000 trading stocks in college, then lost all of it back, every penny. He says that experience was the most important thing that ever happened to him, because after that he had a relationship with losing that most traders never develop. Here's how Lipschutz himself put it. Losing is part of the dance. Most people lose because they refuse to dance with the loss. Notice the word he uses. Dance, not endure, not survive, not tolerate. Dance. Lipschutz isn't saying you have to put up with losses. He's saying you have to get into a kind of partnership with them, a back and forth, a rhythm. Most traders treat losses like an enemy, something to fight, something to defeat. Lipschutz treats them like a dance partner, something to move with. That's a completely different relationship, and it shows up in the smallest moments. When a Lipschutz position goes against him, he doesn't tense up. He doesn't get angry. He doesn't start hoping. He moves with the market, sometimes adding, sometimes cutting, sometimes flipping his position entirely. The loss isn't a personal attack on him. It's information. It's the dance. And here's the thing about a dance. If you fight your partner, you both fall. If you try to lead when you should follow, you trip. If you resist the music, the dance ends. The traders who fight their losses, who refuse to take them, who refuse to accept them, they're not dancing, they're wrestling, and the market always wins that wrestling match. Lipschutz had one famous moment where he held a position that lost so much overnight he had to call his boss at 3 a.m. to tell him the firm might need to be liquidated. The market had moved against him with no warning. He took the loss the next morning, cut the position, walked away. He didn't try to fight it. He didn't try to be right. He danced with the loss and lived to dance another day. That ability to move with a loss instead of against it is what separated him from every trader who blew up at the same moment. The next trader on this list almost didn't make it to the dance floor at all. He lost so badly, so often in his early years, that he nearly quit trading forever. His name was Marty Schwartz. Marty Schwartz is the trader you read about in Pitbull, his memoir of becoming one of the most successful traders of the 1980s. He won the US Investing Championship 4 years in a row, with returns that still seem almost impossible, over 700% in some years. But that's not where his story starts. Schwartz spent the first decade of his career losing money, consistently, painfully, almost desperately. He worked as a securities analyst by day, traded his own account on the side, and watched himself slowly drain his savings year after year. Why? Because Marty Schwartz, in his own words, couldn't stand being wrong. He'd put on a position. The market would move against him. And instead of taking the loss, he'd argue with the market. He'd add to losers. He'd hold positions hoping they'd come back. He'd convince himself that he was right, and the market was temporarily mistaken. Sound familiar? Schwartz almost quit trading. He came close to giving up entirely. The losses were destroying his marriage, his savings, his sense of self. And then he had a realization. The realization wasn't about strategy. It wasn't about technical analysis. It wasn't about a new indicator. The realization was this. He had been trading to be right, not to make money, to be right. Once he saw that distinction, everything changed. Schwartz famously said this about trading. The most important thing is money management. The second most important thing is money management. The third most important thing is money management. Most traders read that quote and think he's talking about position sizing, stop losses, risk per trade. He's not, or he is, but that's not the whole picture. What Schwartz actually meant by money management was emotional money management, the willingness to take the loss without resistance. To cut the position not when your stop hits, but the moment you realize you're wrong. To stop arguing with the market. Position sizing is just the mechanism. The emotional capacity to use it is the real skill. Schwartz's transformation came when he stopped needing to be right on every trade, when he accepted that being wrong was just part of the job. That losses weren't a referendum on his intelligence. They were just what happened when probabilities didn't go his way. The moment he stopped fighting his losses, that's the moment he started winning. And here's something almost no one talks about with Schwartz. After his transformation, his win rate didn't actually go up dramatically. He didn't suddenly become some genius market prophet. What changed was his average loss size. It got smaller, much smaller, because he was taking losses faster, with less resistance, before they grew into account killers. That's the entire game. Now, there's one more trader to introduce before I show you what they all had in common. Not because he traded the most, not because he made the most money, but because he was the one who finally named what these other traders were doing, who took their hard-won wisdom and turned it into a framework anyone could learn. His name was Mark Douglas. Mark Douglas wasn't a famous trader. He didn't make billions. He didn't run a hedge fund. He was a coach, a teacher, a man who spent 30 years studying why traders fail and what the rare successful ones did differently. Douglas wrote 2 books that have become required reading for serious traders. The Disciplined Trader, published in 1990, and Trading in the Zone, published in 2000. Together, those books form the most complete map of trading psychology ever written. And here's what makes Douglas different from the 4 traders we just covered. Livermore, Tudor Jones, Lipschutz, Schwartz, they all figured out the same insight through experience, through pain, through losing fortunes and rebuilding them. Mark Douglas figured it out by watching them, by interviewing them, by studying what they did, what they said, and most importantly, what they believed. And he gave it a name. Douglas called it thinking in probabilities. Here's what that means in plain language. Most traders, when they put on a trade, are trying to predict what the market will do next. They have an opinion, a conviction, a belief that this trade is going to work. And when the trade goes against them, that conviction becomes the problem. They can't let go of it. They can't accept being wrong because their entire psychological framework was built around being right. Douglas observed that the master traders didn't think this way at all. The masters didn't think in terms of right and wrong on individual trades. They thought in terms of probabilities across hundreds of trades. They knew, at a belief level, not just intellectually, that any single trade was just one expression of a probability, that their edge expressed itself across the long run, not in any one outcome. Douglas wrote 5 fundamental truths in Trading in the Zone. The most important one is this: anything can happen. 3 words. And those 3 words contain the entire psychology of master trading. If anything can happen on any given trade, if the market is genuinely random in the short term, then being wrong on a single trade tells you nothing about your skill, your edge, or your future. It's just one outcome out of many possible outcomes. And if you truly believe that, at a belief level, you stop having an emotional reaction to individual losses. Because the loss isn't personal, it's not a verdict. It's just one number in a much longer sequence of numbers. Douglas wrote that this shift, from believing you can predict to accepting that anything can happen, is the single biggest divide between traders who make it and traders who don't. And here's what's remarkable about his observation. Every single trader we've talked about, Livermore, Tudor Jones, Lipschutz, Schwartz, had arrived at this same belief by themselves, through losses, through scars, through experience. Douglas was the one who put the pieces together and showed everyone what they had in common, which brings us to the moment I promised you at the beginning, the single trait these 5 traders all shared. It's coming up next. So here it is, 5 traders, 5 different eras, 5 completely different strategies. From Livermore's tape reading in 1923 to Douglas's psychology research in 2000, they had nothing in common except for one thing: emotional neutrality toward individual losses. That's the trait, not discipline, not risk management, not some secret edge. The capacity to take a loss without it costing you anything emotionally. To accept the financial number on the screen without it becoming an identity wound. To close the position, log the result, and move on without your nervous system treating it as a threat. Each of these traders described it differently, but they were all pointing at the same thing. Livermore called it forgetting the loss overnight. Tudor Jones called it being a premier loss taker. Lipschutz called it dancing with the loss. Schwartz called it money management, but meant it emotionally. Douglas called it thinking in probabilities. Same trait, 5 different names, and here's why this trait is so rare, so hard to develop, so difficult to even understand from the outside, because it goes against everything human nature wants you to do. Your brain, the brain you inherited from millions of years of evolution, is not designed to be neutral about losses. It's designed to feel them, sharply, personally, permanently. Loss aversion is one of the most well-documented psychological biases in all of human behavior. Studies show that the pain of losing $100 is roughly twice as strong as the pleasure of gaining $100. Twice as strong. That's not a flaw. That's how your brain is supposed to work. In every other domain of life, that bias keeps you alive. It teaches you to avoid danger, to learn from mistakes, to not repeat behaviors that hurt you. But in trading, that bias is the single biggest obstacle between you and consistency, because trading requires you to take losses constantly, by design. Even the best traders in the world lose on something like 40 to 50% of their trades. The math only works if you can take those losses without flinching, and that's why I want to share this with you. Imagine a casino, any casino, Las Vegas, Monte Carlo, wherever. When a single hand of blackjack goes against the house, when a player wins $20,000 on a single bet, does the casino panic? Does the casino reconsider its entire business model? Does the casino fire the dealer? Of course not. The casino has an edge, a small statistical edge that plays out across thousands of hands per night, millions of hands per year. A single losing hand is just a single losing hand. The math is the math. The casino is emotionally neutral about any individual outcome, because the casino understands its edge expresses itself over time, not in any single moment. Now, picture an amateur trader. They put on a trade. Their stop hits. They take a 1% loss. And what happens? They don't shrug. They don't move on. They feel something: frustration, self-doubt, the urge to revenge trade, the need to immediately make it back. They're treating that single loss like it means something, like it's a verdict on them as a trader. But statistically, it's just one hand, one outcome in a long sequence, one number that says nothing about their skill or their edge. The amateur is the gambler who feels personally defeated by every losing hand. The master trader runs the casino. That's the trait. That's what separated Livermore, Tudor Jones, Lipschutz, Schwartz, and Douglas from every trader who blew up beside them. They had built, through experience, through pain, through deliberate practice, the ability to be a casino, to take losses without emotional reaction, to trust their edge across hundreds of trades instead of needing to be right on any single one. Now, the question that matters: can you build this trait? Yes, and it's simpler than you think. Building emotional neutrality toward losses isn't a personality trait. It's not something you're born with. It's a skill, and like any skill, you build it with deliberate practice. Here are 3 concrete shifts you can start making today. Shift number 1. Track your win rate over 50 trades, not 5. Most traders evaluate themselves on far too small a sample size. They take 3 losing trades in a row and immediately think something is wrong. Their strategy is broken. Their edge is gone. But statistically, 3 losses in a row mean almost nothing. If your strategy has a 55% win rate, which is good, by the way, you'll have streaks of 3 losses fairly often. You'll have streaks of 5 losses occasionally. Even a streak of 7 losses isn't outside normal probability. The amateur emotional spike comes from misreading the signal, from treating a normal probability streak as a verdict on the strategy. Track your performance over 50 trades, or 100. Look at your overall win rate. Look at your average win size versus your average loss size. Look at your expected value per trade. When you train yourself to evaluate over the full sample, not the last 3 outcomes, losses become statistical events instead of personal failures. That single mental shift will save more accounts than any indicator ever has. Shift number 2. Pre-decide the loss before you enter. This is Mark Douglas's exercise, and it's deceptively powerful. Before you enter any trade, before you click buy, visualize the worst case. Imagine your stop loss hitting. Imagine the position closing at a loss. Imagine that exact dollar amount leaving your account. Now, ask yourself a question. Can you fully accept that loss, right now, before the trade? If the answer is yes, take the trade. If the answer is no, if you'd be upset, angry, frustrated, or feel like a failure, the position is too big. Cut your size in half. Ask the question again. Cut again if needed. Most traders skip this step entirely. They put on positions assuming they'll be right, and then when they're not, the loss feels like a violation, like something that wasn't supposed to happen. The masters had already accepted the loss before they entered, so when it came, it was nothing, just the price of admission. Shift number 3. Journal the emotion, not the trade. Most traders journal what happened, the setup, the entry, the exit, the result. That's fine, but it's not what builds emotional neutrality. The masters journaled how they felt about what happened. They tracked their emotional reactions. They looked for the gap between their gut response and the actual statistical event. After every losing trade, write down 2 things. First, the financial outcome, the dollar amount, the percentage, whatever you'd normally track. Second, your emotional reaction on a scale of 1 to 10. 1 being completely neutral, 10 being deeply upset. Then ask yourself, does my emotional reaction match the statistical importance of this single trade? Almost always, the answer will be no. You'll feel a 6 or a 7 about a trade that mathematically deserves a 1 or a 2. That gap between your emotional reaction and the actual statistical event is exactly what you're working to close. Over time, with practice, the gap shrinks. Your emotional reactions get smaller. Your nervous system stops treating individual losses as threats, and one day you'll take a loss and feel nothing. Just the math, just information, just the dance. That's when you've crossed over. Let's go back to where we started. Jesse Livermore in 1923, Mark Douglas teaching beginners 6 decades later. 2 men separated by 60 years, 2 world wars, and a complete transformation of how markets even functioned. They arrived at the same insight by completely different paths. Tudor Jones got there through the '87 crash. Lipschutz got there through losing his inheritance. Schwartz got there through a decade of failure that almost broke him. 5 different journeys, 1 destination. The masters didn't have better strategies than you. They didn't have secret indicators. They didn't have inside information. They had a better relationship with being wrong. That's it. That's the entire difference. And the most encouraging thing about this is, you don't need decades of pain to develop it. You don't need to blow up an account 3 times. You don't need to lose your inheritance. You just need to start practicing the 3 shifts I showed you. Track your win rate over 50 trades. Pre-accept the loss before you enter. Journal the emotion, not just the trade. Do that consistently for 3 months, and you'll start to feel something most traders never feel. A loss happening, and almost nothing happening inside of you. Just the math, just the dance, just another hand in a long, long game. That's the trait. That's what separates legendary traders from everyone else. Now, before I close this video out, I want to ask you something. If anything in this video shifted how you think about your own trading, even 1 sentence, 1 quote, 1 moment, take 3 seconds and hit the like button. It's a small thing, but it tells YouTube to put this kind of content in front of more traders who need it. And if you want more videos like this, going deep on trading psychology, breaking down what the masters actually understood, subscribe to The Disciplined Trader. This channel is built for traders who know the technical side isn't the problem. The mindset is. One more thing. I want to hear from you in the comments. Out of these 5 traders, Livermore, Tudor Jones, Lipschutz, Schwartz, Douglas, which one's words landed hardest? Which one made you stop and think, that's me? Drop the name in the comments. I read them all. And the patterns in your answers shape the videos I make next. Now, here's what I want to leave you with. In the end, the market isn't your opponent. You are, and the trader you're becoming is the only edge that lasts.